Listen up, this might be the most critical video you watch all year. Right now, UK directors, exactly like you, are being blindsided by personal liability. Now, most people thought your company debts would stay with the company, right? Think again, because I'm about to share with you 7 ways you could end up personally liable for company debts. They're not just technicalities, they're serious, and I'm seeing them catch a lot of directors off guard right now in 2024. And that's whether you've taken out a bounce back loan, signed a personal guarantee, or maybe just followed what you thought was normal practices. These traps can still hold you personally liable, and I'm going to cover not only the pitfalls, but the strategies to protect yourself. So stick with me. Chris Worden, Director First, welcome to the channel. First up, let's talk about bounce back loan misuse. So, the bounce back loan scheme was launched in 2020 and it was a lifeline for millions of struggling businesses. You could apply for up to 50 grand, interest free for the first year, hardly any checks get done. Sounded like free money, okay? Here's the catch. That money was strictly for business purposes only. Now, there are several ways directors have gotten themselves in trouble with this. So let's break it down. The number one, by far and away the biggest problem, is a director misrepresenting their turnover. So the loan amount you received was based on your business's turnover in 2019. And if you boosted those numbers to get a bigger loan, that's a clear misuse. Some directors got tempted to inflate turnover, thinking it'd never be checked. But liquidators and the banks now are reviewing those numbers. And if they find out that your turnover was over-egged, you're looking at a potential fraud investigation. And that can be personal liability to repay the loan. Now, a lot of people said, well, I could estimate my turnover. You could if you was incorporated after 2019. But hear this, if you estimated your turnover, you really should have had some workings out as to why you was going to estimate it, because they're pulling people. I've seen a director disqualification this week from someone who was in 2019, estimated their turnover, they liquidated, and the insolvency service are all over them. Another reason is you use the loan for personal expenses. Now, the bounce back loan, remember, it was meant to support the business, payroll, rent, stock, expensive debt. But if any of that money went towards personal expenses like paying off your mortgage, buying a car, paying off your credit cards, that is misappropriation. And a liquidator will flag these transactions immediately and chase you to repay that amount from your personal assets. Now, lots of people took loans when they weren't entitled. Like, another red flag that I'm seeing is someone took a loan when they weren't eligible. Now, let's say you had a dormant company, or if your company wasn't actively trading and you still applied, that's misuse. These loans were designed for actively trading businesses that needed help to stay afloat during the pandemic. If you didn't meet those criteria, you're at serious risk of personal liability if the loan is called into question. So what can you do about it? If all of this sounds familiar, the key thing is to act now, Review what you spent the bounce back loan, review your projections. If you've took some personal expenses, try and get it paid back into the business. And if you've inflated your turnover, I'd suggest you get that loan paid back as soon as you possibly can. Now, if you do get questioned about what your turnover, why your turnover was what it was, the best defence is to show a paper trail and a proactive effort to set things right. Now, number 2, where people are getting made personally liable, and I bang on about this every month, is overdrawn directors' loan accounts. Let's dive into them. I want you to think of a director's loan account as a kind of personal bank account within your business. And every time you take money out for personal use, it's recorded as a loan to you. And it's up to you to pay that money back. Now here's where directors often slip up. An overdrawn loan account is when the amount you've taken out exceeds the money that you've put in. So let's say you took 10 grand out to cover a personal expense, planning to pay it back later, but the company runs into trouble and you can't return it. You've got an overdrawn loan account. Most people take out of their business, like say £1,000 a month salary, and they take another £3,000 a month as what they class as a dividend. Well, until you do your accounts, it's not a dividend. While you're taking that £3,000 a month out, it's a drawing that goes on your director's loan. Now, as long as you make enough profit, at the end of the year, the accountant will declare a dividend and you will pay your personal tax and the business will pay corporation tax. But here's the problem. When your business starts to struggle, the revenues fall, profits fall, but you're still taking a large amount of money out of your business might not be able to afford it. And that's the problem. If you're not being advised to watch how you're taking your money, if you're starting to struggle, my advice is start taking your money through the payroll. And this is so common. Honestly, like 90% of my jobs have them. The key to fixing this is, listen, if your account's overdrawn and you go into liquidation, declare it up front with the person you're speaking to. Anybody who doesn't mention this to you before you go into liquidation with them, you need to think, why are they not mentioning it? What we do at Director First is we help you understand, if you've got a director's loan account, what is it? Not what it says in the last set of accounts. That's not a true reflection of what it is today. We'll help you work out what is your director's loan account at the point of going into liquidation. Because once you're in liquidation, a liquidator is going to ask you to pay it back. And this frightens the life of a lot of people, and it should do, especially if you've got assets. Listen, if you're in rented accommodation or very little to lose, a liquidator can't get anything from you. But if you've got assets and you've got savings, this is where they come at you. Now, what you've got to do is, before you make any decision to appoint that liquidator, you want to come to an agreement in principle on what your director's loan account is. And the more you've got to lose, the more you need to worry about this. Do not be signing with anybody until this conversation has been had and it's been put in writing. Honest to God, I'd say every day, we get calls off people who've gone into liquidation with other firms. They've not discussed this overdrawn loan account. And once you've appointed a liquidator, they're coming for you. And it can cause huge problems. And number 3 is preference payments. Okay? Imagine your business is in financial trouble. You've got creditors demanding payment and you decide to repay a close family member or a personally guaranteed debt first, thinking it's the right thing to do. But here's the problem. It's favouritism in the eyes of the insolvency practitioner, because when your company's insolvent, you can't pay your debts on time, liabilities are more than the assets, every creditor is supposed to be treated fairly, and if you choose to repay one over another, it's called a preference payment. Let's go through a few examples. I see a lot where people repay family or friends. You might have borrowed money personally from them to keep the business afloat, and now you're trying to pay them back first. But the problem is if your business goes into liquidation, those payments can and will be reversed. Liquidators will see that as an unfair preference, meaning they'll demand payment from you directly. Another thing is paying off a loan that's personally guaranteed. Maybe there's somebody out there, you know you've got a PG on it and you want to keep them happy by settling the debt before the liquidation. Well, if liquidation happens, that payment can be challenged, and again it can be set aside, and it's something you could be made personally liable about. Now, how do you avoid making these preference payments? Well, you've got to create a plan to create, if you're going into liquidation, you've got to pay people fairly. Now there's an argument to say that if you are unsure of whether you're liquidating or not, you could continue to trade with key suppliers, because you get, by paying the supplier, you're getting more stock, more stuff to bring in more money for creditors. But it is a tightrope. The key thing is you've got to take advice early. If you're thinking, Chris, what you've said's worried me so far, give us a call, book a meeting in the comments section below. Again, document your decisions with this type of thing. Another trap for personal liability is obviously personal guarantees. You know, many directors will sign these without fully understanding what they're committing to. Now, it's a commitment that if your business defaults on a debt, you're going to cover it personally. And if the company goes into liquidation with debts tied to personal guarantees, you're going to be liable to cover those debts directly from your own assets, from your own pocket. And here's why the PGs are so risky. They pierce limited liability. Normally, as a director, you're protected by the corporate veil, meaning your personal assets are safe from company debts. But a personal guarantee overrides that, and it allows creditors to come after your home, your savings or other assets if the debt isn't paid. And they can pursue legal action quickly. Sometimes you don't even have to wait for an insolvency process. They're on the phone and they're making demands for immediate payment. Now the key to this is, if you're on the hook for a personal guarantee, your best bet is to have a plan of how you're going to deal with that personal guarantee post-liquidation, and we can help you with that. We know lots of directors who've signed personal guarantees, and the good news is as long as you are proactive and you deal with it head on and negotiate some type of arrangement, and that could generally be even smaller payments for a while you get back on your feet, or extending the loan term over a longer period of time, in most cases you'll stop action. The lenders just want their money back. But the key thing is, first of all, be careful before you bloody sign them. But if you've signed them and you're going into liquidation, you've got to get a plan to deal with it. Number 5 I want to talk to you about where you might be made personally liable, is wrongful trading. And wrongful trading is when you continue to run your business when you know, or you should know, that it's insolvent. Because it's your duty as a director to stop trading if it's clear that your company cannot realistically pay its debts. And the key warning signs of wrongful trading are, mounting debt with no clear way to pay. If you're racking up more debt every month without any realistic plan to repay it, you might be trading wrongfully. If you can't pay payroll or rent, if you can't make essential payments like staff wages or rent, it's a major red flag. And the way to avoid an accusation of wrongful trading is to keep a close eye on your company's financial health. And if you suspect insolvency, pick the phone up. Get some free, independent and impartial advice from director first, because we can help you assess whether continuing to trade is viable or you should start looking at insolvency options. Everybody is more lenient on directors who act responsibly and seek help rather than those who try to push on hoping for a miracle. Honestly, you've got to see things as they are, not worse than they are, not better than they are. Take them rose-tinted glasses off and document all your decisions, especially if you're starting to hit troubles. Now, the next thing that's a bit more serious is something called fraudulent trading. It's even more severe, carries much heavier penalties. And this is when you actively deceive creditors knowing your business can't pay them back, or when you deliberately mislead creditors or customers. Fraudulent trading is criminal, and it could mean fines, personal liability and even jail time. So let me give you an example of fraudulent trading. You could be putting out misleading financial statements. If you're inflating income or hiding debts in your statements to make the company look solvent, that's fraud. If you are going out there taking customer deposits with no intention of fulfilling what the customer's paid for, that is fraudulent trading. And the simplest way to avoid it is transparency. Make sure your books accurately reflect what's going on, even if it's not ideal. Don't be taking deposits if you pass that point of no return. And again, speak to people, speak to your creditors, speak to an insolvency professional quickly. You know, the last thing I want to touch on is personal liability notices, PLNs for short, and we are seeing more of these in 2024, and it's issued by the HMRC if they believe that you've abused or neglected your company's tax responsibilities. That's VAT, PAYE, corporation tax, and when they issue a PLN, they're making you personally liable for those unpaid taxes, and the consequences can be very severe. There's some key triggers for personal liability notices, you know, repeatedly missing tax deadlines, habitually late or missed tax payments are a red flag, unreported tax liabilities. If HMRC find discrepancies or suspect you've unreported, they can investigate you and they can issue a PLN. And the best way to avoid one of these is to stay on top of your tax obligations. We know it's not possible for everyone, but if you're struggling to meet the tax deadlines or you're struggling to pay HMRC, get advice early. If you ignore the tax responsibilities and you ignore the HMRC, it's a quick way to find yourself personally liable. So there you've got it, 7 ways that you could be made personally liable for your company debts. These risks are real, but there are steps you can take right now to protect yourself. Awareness and proactive action are key. Do not wait until it's too late. And if any of these situations sound familiar, get some expert advice right now from Director First. We are here to help UK directors navigate these challenges. Hit that subscribe button for more insights. And if you're facing any of these issues, reach out to us. We're free and independent and impartial. Thanks for your time. My name's Chris Worden.